Welcome to Medicare and Health Savings Accounts, or HSA's Basics Explained. In this session, we'll cover what you need to consider when you have a health savings account and become eligible for Medicare. What you'll learn includes who is eligible for premium-free Medicare Part A hospital insurance. Next, we'll describe how the Medicare Part A 6-month retroactive benefit period works. Then we'll explain who is an HSA-eligible individual and who can make contributions to an HSA account. Next, explain how contributions into an HSA may be limited by the 6-month retroactive benefit period and penalties for excess contributions. Then, describe which Medicare-related premiums are considered qualified medical expenses for HSA distributions. And finally, list 5 ways to maximize HSA contributions once an individual becomes a Medicare beneficiary. First, let's discuss premium-free Medicare Part A hospital insurance. Individuals who have paid into the Medicare Trust Fund in the form of FICA taxes for at least 40 calendar quarters or 10 years will receive Medicare Part A at no cost when they become Medicare eligible. Next, let's discuss premium-free Medicare Part A hospital insurance and the 6-month retroactive benefit coverage period. Medicare-eligible individuals who enroll in Medicare benefits for the first time, who missed their initial enrollment period when they first turned age 65, and are eligible for premium-free Medicare Part A, are covered retroactively up to 6 months from the month they enroll in Medicare. So let's look at an example. Here we have an individual who turned age 65 in April of last year. However, if an individual turned age 65 on the 1st of the month, in this case April 1st, then their Medicare eligibility begins on the 1st of the previous month, in this example March 1st. So let's assume this individual turned age 65 on April 15th, then they are entitled to Medicare effective April 1st. Premium-free Medicare Part A hospital insurance starts no earlier than April, the month they were first Medicare eligible, then continues for up to a maximum of 6 months. As the individual delays their Medicare enrollment, in this example, they have creditable health coverage through their large employer group health plan. The 6-month window of retroactive coverage continues indefinitely. Think of it as a rolling 6-month period of time. Once a Medicare-eligible individual enrolls in premium-free Medicare Part A hospital insurance, they are now entitled to 6 months of retroactive benefits. For example, when the individual loses their creditable health coverage from their large employer and enrolls in Medicare using a special enrollment period, or SEP for loss of employer coverage. Now let's look at how tax-free contributions to a health savings account or HSA are affected by enrolling in Medicare Part A. Health savings accounts, or HSAs, are individual financial accounts owned by one person. The amount that can be contributed to an HSA account depends on the type of qualified high-deductible health plan they have and when they became HSA eligible. The amount they can contribute to an account depends on the type of health coverage they have, either self-only or family coverage. In either case, the eligible individual, that is, the account holder or any other person, can contribute up to the maximum amount for the type of coverage they have. Section 1201 of the Medicare Prescription Drug Improvement and Modernization Act of 2003 added Section 223 to the Internal Revenue Code. It permits eligible individuals to establish health savings accounts. According to this later IRS 2004 notice, an eligible individual can establish an HSA if they are covered by a qualified high-deductible health plan, or HDHP, and not covered by any other health plan that is not an HDHP, and not enrolled in Medicare. A subsequent IRS 2004 notice describes in more detail that once an individual account holder is entitled to benefits under Medicare, that means both eligible and enrolled, they can no longer contribute to their HSA accounts. In other words, simply being Medicare eligible does not prohibit an individual from contributing to an HSA. Only when an eligible individual also enrolls into Medicare and becomes entitled do contributions end. What if an HSA-eligible individual, the HSA account holder with family coverage, has a Medicare-entitled spouse? According to the IRS 2004 notice, the eligible individual with a high-deductible health plan with family coverage can contribute up to the family maximum, even though their dependent is on Medicare. The dependent cannot contribute to the HSA. But how does an individual account holder who can no longer contribute to an HSA, because they are now entitled to Medicare, determine their last month of HSA contributions? That's where the 6 months of retroactive coverage under Medicare Part A comes into play. In our previous example, the individual was eligible for Medicare in April of the previous year. The Medicare-eligible individual did not enroll in Medicare Part A until April of the current year due to leaving or losing their employer's high-deductible health plan using a special enrollment period. Because the individual is entitled to premium-free Medicare Part A hospital insurance, their benefit is retroactive by 6 months. In this case, back to November 1st of the previous year. As shown here, in the previous calendar year, the individual can contribute to their HSA for the months of January through October, for a total of 10 months, but not November or December, and cannot contribute in the current calendar year, since the months of January through April are also included in the Part A retroactive benefit coverage period. So, for example, let's look at HSA contributions for self-only coverage for calendar years 2025 and 2026, and what the correct HSA contribution for this Medicare beneficiary is. For calendar year 2025, it's 10 months, January through October, of the annual maximum self-only amount, plus a catch-up contribution for being 55 and over. So let's do the numbers. $4,300 self-only maximum, plus a $1,000 catch-up contribution. So the total maximum annual contribution is $5,300. But to get the 10-month amount, you multiply by 10, then divide by 12. So the maximum self-only HSA contribution limit for calendar year 2025 is $4,416. For calendar year 2026, there are 0 contributions, since the first 4 months are part of the Part A retroactive benefit coverage period. So, what happens if an individual contributes too much to their HSA account? According to this IRS publication, excess contributions are not deductible. If excess contributions are from an employer, the employer must include them as part of an individual's gross income or as other income. Otherwise, an individual must pay a 6% excise tax on excess contributions. Normally, insurance premiums are not considered qualified medical expenses for distribution from an HSA account. However, once an individual turns age 65 or older, HSA funds can be used for Medicare-related premiums, such as Medicare Part A, if applicable, Medicare Part B medical insurance, Medicare Part C Advantage plans, and Medicare Part D prescription drug plans. The one exception are premiums for Medicare supplements or Medigap insurance plans. They are not considered qualified medical expenses by the IRS. Finally, since Medicare Part B and Part D premiums are already a qualified medical expense, IRMA surcharges are also considered as part of the premiums. So, how does an individual maximize their HSA contributions once they become Medicare eligible? First, delay enrollment in Social Security benefits. Enrolling in Social Security benefits automatically triggers enrollment into Medicare Part A and Part B. Second, if you don't need Social Security benefits and delay enrolling in Medicare Part A. For example, if you have creditable coverage from an employer's high-deductible health plan, there is no requirement to enroll in Medicare Part A. Third, stay on a high-deductible health plan to continue contributions to an HSA. Fourth, contribute the maximum allowed every year into an HSA. Finally, contribute the $1,000 annual catch-up contribution for being age 55 and over. Together, Medicare-eligible individuals can maximize their savings, tax-free, for future Medicare-related out-of-pocket medical expenses. For more information about Medicare and HSAs, go to official government websites. or contact your trusted state licensed, Medicare certified, independent insurance agent.